Mohammed Apabhai. Mohammed, welcome to India, and finally good to see you in person. Should we pick it up from where we left last time?
Sure.
You know, when we spoke about 2 weeks ago when Dow had fallen by 1,000 points, your view was that don't be in a hurry to buy. Global markets would cave in more. But the screen is telling me a different story. The comeback has been slightly unreal. Dow is less than 3% away from a record high.
Yes, it's very hard for people to come in and tell you that they've been wrong about things, but I'll happily do that. The markets are the greatest humblers, I think, of people. And let's just rewind it and look at what happened. I mean, the low has been hit very much by the Bank of Japan governor coming in and giving his comments on that. What has happened is that investors looked at the markets as they fell through their start of year level and started buying again. Now, I think some of that was technically driven because we had holidays, and we had the Chinese New Year holiday, we had the President's Day in the US, and so people closed back their positions. Now, in the last 48 hours, what we've seen is two days in the US at least of more than 1% return. Now, this is a very different market to what we saw in 2016 and 17, where the market would just grind up roughly 10 basis points a day. So what it means is that 1%, 1.2% return a day is still something like 18, 19% volatility. So we're not quite yet out of this volatile period. Now, in the next week or so, we've got a lot of significant events coming up. We've got the Powell testimony, which is later tonight. This is the first time that we're going to hear Mr. Powell speaking in his capacity as the Fed chair. We really don't know what tone he's going to set, and you know, we're thinking that it will be a continuity of what the previous Fed governors have talked about. So that's very much a focus. And then an event that is happening in Italy over the weekend is the Italian election, which I think many market participants haven't looked at. And then we'll be hearing from the ECB and the Bank of Japan next week. We also have China's trade representative going to the US as well. So there are still a lot of catalysts that are going on. Volatility is not high, but it's certainly not as low as what it was a year ago. And we need to continue to be aware of the catalysts for the sell-off a few weeks ago was really a volatility jump. So if you get a volatility jump, and especially if you get bond market selling off at the same time as equity market selling off, so if it becomes a concern that bond yields are going too high, then actually you could see a resumption of that selling. So really recently what we've seen is bond yields went up to about 2.92%. They've come back. I think they're waiting for Powell. This perhaps could be the calm before the volatility picks up on the downside again.
So, you know, as we roll over to different time periods, do you think 2018 could be a nasty year and we are not done with the lows and a more sharpish correction is coming?
It is possible. I mean, we know roughly where the levels are on market. So, you know, we obviously know that the start of year level is a very important level. The VWAP entry level for the year was the level where people initially started selling. And it's at that point people have to decide whether they're going to hold those positions or dump them. It just so happens that, you know, it seems that Japanese pension funds stepped into the market, started buying again, and that seemed to help the market to stabilize. But really, if we go back to the lows of earlier this month, or even if we just break down through the start of year level again, what we'll actually see is the market turning from rotation, which is really what we're seeing right now, to outright liquidation. But it's a bit too early to say that we're out of the woods. You know, some of the things that are concerning us is still some of the funding pressures that we're seeing in the rates markets. But obviously, if we break above the highs, then clearly we've been wrong about this. One thing I should say about India is that many of the main concern that we have about India is mainly from external factors. There's nothing domestically about India that we're hugely concerned about. There is some concern around the MSCI announcement, and again, it's not our core scenario that we think that a resolution will be reached. The concern really is that foreign investors are already overweight in India. While this uncertainty continues with the MSCI, it may be the fact that overweight investors just stop allocating more until they get the green light from MSCI. And at that time, if you get something happening in the currency market or the bond market as well, that is a potential risk. But again, I think investors, certainly in the options market, the probability of no deal being reached by the end of June is something only like 3.8%. And that to me seems a little bit low.
Do you think we should ignore the so-called MSCI tantrums? It's none of MSCI's business to comment about what exchanges are doing. I mean, that's a private matter between Indian exchanges and SGX. I mean, MSCI is in the business of making an index which is based on free float and market cap. And I don't think the fall off between SGX and BSE and NSE will have an impact on the MSCI methodology. I mean, are they simply trying to showcase their power to protect future business?
No, certainly not. I think this idea of them showcasing their power, no, that's not what MSCI do. I mean, I've been dealing with various members of them for nearly 2 decades now. The MSCI rules are very clear. They're very rule-based. And really what they're doing is just reiterating what the rules actually say. And what I think needs to be done is both sides need to get together, obviously, which I'm sure they are doing already, and some agreement needs to be reached as to how this can be done. The problem that there exists is if there is a strict interpretation and it results in a declassification. And again, I would highlight, this is not the core scenario, but this is not a black swan event, but it is now becoming a tail risk. The foreign investor positioning, a lot of, or some of it at least, is benchmarked to the MSCI, which means that if you're not in the benchmark, that index money would have to sell. But benchmark money, some of those funds would not be able to own Indian equity in the same way. This is a risk. It's not a core scenario, but it is a risk and something that we're watching. But I think the more significant risk is that while this uncertainty goes on, overweight foreign fund managers may actually just go on a buyer's strike and not actually add to positions.
What, to your mind, could be that big long and short trade for 2018, where you're not thinking in terms of days, weeks, but you're thinking in terms of months and years?
I think that one trade that I think is quite significant is that I think that treasury bonds are probably approaching their lows for the year. There's a lot of question about whether we've reached whether we've broken the trend of the last 35 years. My view is that we haven't. There's nothing magical in the bond market about 3% or any other level. Certainly the downtrend is intact in bond markets, while 10-year bond yields in the US remain below 3.45%. I do think that the US Treasury curve and swap curve will continue to flatten. I think that will invert, but that will be a third quarter event. I think yen strength is probably going to continue as well. I think depending on what the US does in terms of the currency, there does seem to be a willingness on the part of the US to see a weaker currency. Then gold also continues to remain fairly attractive in terms of both its ability to hedge against any sort of risk-off event, but also in its ability to hedge against extremes in inflation, either deflation or disinflation or significant inflation as well. So I think those are some of the things that we are quite liking. I think equities as well look good. I mean, we've described equities right now, even in India, as fair, maybe not cheap, but certainly fairly valued. that means that basically if there was a fall, they would become cheap, and that would be a very significant opportunity to buy into them. But I think equities as well should be okay for the next 12 months.
So what is that threshold limit beyond which you would say, look, markets would panic? I mean, this is my number for the US 10-year paper, and if it goes above that, it's time to go back to basics and ask yourself a question that, can equities go up if interest rates are going higher? 3% may not be that number, but I'm sure you must be having an internal number in mind.
I don't think there is actually a level. I think what it is that the market doesn't adjust very well to periods when there's a large change. So it's the pace more than the actual level. And I think this is an important point, that this sell-off that we saw has been very strange, because normally what you see is an equity market sell-off leading to a rise in volatility. Here what we've seen is a rise in volatility and a rise in correlation between bond and equity markets actually leading to an equity sell-off. So to us, if you saw a rise in treasury volatility and you saw the equity markets going down as bond markets were falling, i.e. a rise in correlation between bonds and equities, that actually is far more worrying than anything else. And a lot of that is technically related. That's technical. I'm not talking about technical analysis here. What I'm talking about is basically fund managers having to target a certain volatility level and having to reduce their positions. And in that scenario, equities are actually far more vulnerable than bond markets are.
The global money is now migrating towards ETFs or active funds and the passive watches, or I mean the passive funds, not active funds. And the so-called passive money is considered to be dumb money. They don't care about valuations. They only talk about correlations and risk management. So in the light of the sell-off, what we've seen in the month of Feb, and the fact that ETFs now dominate the world, what is in store for us?
That is certainly quite significant. I mean, it sort of means that there is going to be this sort of herding in, herding out sort of mentality. Often the ETF allocation money can be funds doing internal asset allocation. So if you're running a global fund, it may be that so you have some small emerging market, and it's not worth doing a huge amount of work on it, so you basically take exposure in that market through ETFs. But for that market, if the fund is large enough, can actually be fairly significant. What it does mean is that we do need to be aware of other drivers apart from fundamental drivers in terms of the market drivers. One thing that has been very interesting is that this bounce back has happened on very low volumes. So, for example, on volumes are down about 50% in February from where they were in January globally. On Friday, we had the lowest volume day of the year in Japan, in the US, in Hong Kong as well. And what this could be reflecting is that as volatility resets higher, and volatility resets higher with higher bond yields, as volatility resets higher, equity positions actually get taken lower, because people are not investing in dollar notional amounts. What they're investing in is unit risk amounts. And as the risk rises, basically what it means is that equity positions have to be taken lower. So until the volumes come back, I think it does feel at the moment like a very low conviction market. We've seen fund managers stepping in, long-only fund managers stepping in, and fast money buying into the dip as well. But what has been very interesting is that the amount of hedging that we've seen by long-only fund managers has actually picked up quite a lot in the last few weeks. And if we look at India, for example, in the last 2 weeks, we've probably seen more hedging than we have done in terms of dollar notional amount in the previous 3 months.
What could be the joker in the pack? Will it be the US Fed? Or will it be oil? Because frankly, the US Fed rates are lacking the 10-year paper, and we've seen that Fed, if they smell that recovery is real, they can keep on increasing Fed rates outside the committee meetings also.
They can do. I think the thing is that would be a huge shock, and the Fed's policy has been not to surprise the market. The Fed tries to signal a long time before it happens, unless they really do want to shock the market, and I don't feel that like they want to right now. In terms of the unforeseen circumstances, I mean, our view is that oil is under structural pressures. We're expecting lower oil prices later this year. We think that inflation is actually going to be heading lower on a global basis later this year. We're already starting to see countries like Japan. I think with the exception of the UK, there's not really any major global economy which is breaking its inflation target. So inflation probably lower by the end of the year. US real rates will actually go higher as a result. And certainly if some of the Fed governors are to be believed, and there's going to be 4 rate hikes in 2018, the market will have to readjust to that. My view is that if that happens, what you will see is what's called a bear flattening, which is short-term rates will go higher, but long-term rates will actually come lower, and you actually get a flattening of the yield curve. If that happens, that will actually be quite negative for financials.
So, you know, as we wrap up today's discussion, and I don't want to get this wrong for our viewers, what you're trying to indicate is that, look, you don't see there is a bear market has started. If you are in market timer, maybe you could get better entry points. But if you are in for the long haul, 2, 3, 4 years, the fact that growth is coming back, we must cherish it rather than running away from it.
Well, my view on growth is actually a lot more sanguine than other people. My view on growth is that a lot of it has been supported by the liquidity that we've been seeing. We'll have to see once the liquidity goes away whether the growth is still there or not. In a way, if the growth is not there, then we know that the game that we've been playing for the last 8 or 9 years, which is the central bank money coming in and helping risk asset prices rally, that game will continue, and that's actually a much more comfortable world from the world of trading than trying to adapt to a new world where everything is normal and you're going back to the normal cycles of boom and bust.
Okay, so you know, final question: if a client walks up to you at the Citi conference right after the interview and he says, "Mohammed, here's my check, $50 million for you. You have the freedom to trade, invest, do what you want to do. I can digest a 10% volatility, maybe a 5-7% downside, yes, but I want absolute double-digit returns for next 3 years." How would you invest that money? Oh,
next 3 years is beyond my remit. Next 3 days is normally quite difficult. I think you know, what I would do is again urge the need to maintain balance within portfolios. It is right to have equity in your portfolio.
How much equity?
Whatever risk you can stomach. And this is what we're saying. You know, we think we know where the downside is going to be. The volatility looks like it's going to be resetting to a higher level, somewhere between 13 to 18% maybe, and so that's the level of risk that you should be looking at within the portfolio. But I think the worst thing you can do is lose sovereignty over your portfolio. Right? You never want to be in a position where, in my case, either my wife will tell me stop trading, or in the case of a fund manager, a risk manager will tell you to stop trading. So I think from that perspective, it's, you know, I'm not telling you anything that you don't already know. Risk control is important. We are resetting to a higher volatility world. You do need to review the positions that you have and the ability to withstand those corrections. So for example, in India, if you had a correction down to the liquidity put, where the central bankers would be acting, you'd be probably somewhere around the 9,600 level. Now, if you have a scenario where not only is the liquidity put delayed in its activation, but you find that the equity market could actually not have much depth and people needed to get out, the stress test would really be around 8,300. And I'm not saying the market's going to go there. I'm saying these are the levels that we'd be looking at in terms of markets on the downside as massively attractive opportunities to buy into. The question is how much of your portfolio you'd be able to keep at that level, especially if you're an institutional investor.
Okay, so closing comment, I'm just tempted to ask this question. This could be really outside the preview of the Citi Conference 2018. When you look back and say, look, you know, this is one trade I did when I went against the general consensus. I had my numbers in right, I had my view in place, and I went and executed that trade, and bam, I made money for my clients. Which is that one trade you just want to feel very happy and proud of?
Oh, you only want one?
A big one.
Well, of course, we are all legends in our own mind. But I think that Identification of the liquidity put has been a very important part of the work that we've done. I think the European crisis, 2012-13, I think the March 11 earthquake has been another one. More recently, I think some of the work that we've done in foreign exchange markets in terms of the game theory analysis and knowing about the Shanghai Accord has been quite significant. I think overall the framework that we've built, I think, is robust. It explains quite a lot of what is going on. You know, it's sort of, people pay a lot of attention to earnings and various other things, which obviously is important. I'm not going to say that it isn't. But all the time when we're in trading, the thing that we need to understand is what is the one key factor that is driving the market right now. And that's really what we're trying to identify.
Wonderful, lovely interacting with you, and enjoy your stay in India.
Thank you very much.